Welcome to this tutorial session with me, John Katita. In this video, we are going to be talking about introduction to bank reconciliation statement. So this is an introductory video where I'll be explaining the concept behind the bank reconciliation statement. So how we are going to move here, I'll first define what a bank reconciliation statement is, and then I will also show you the format for bank reconciliation. And then the last thing is that I'm also going to explain the terms that we use under bank reconciliation statement to help you guys understand as you are going to be solving your questions. So to start with, a bank reconciliation statement is just simply a statement which reconciles the cash book balance and the bank balance. So you find that many times your cash book balance will be different from your bank balance due to the following reasons. So there's usually a difference between the cash book balance and the bank statement balance due to the following reasons. So these, the ones I wrote in red, are the differences that cause the cash book balance and the bank statement balance to differ. So there is bank charges, errors and omissions, standing orders, unpresented checks, uncredited checks, direct debit, direct credit, credit transfer, and debit transfer. So I'll explain all these to help you guys understand. So you find that for a business, every business, they always have the bank side. On the bank side, that's where they keep money. So on the cash book, it's the business keeping the records of their bank transactions. And then on the bank statement, it's the bank keeping records on behalf of the business. So in most cases, these businesses, they receive bank statements on a monthly basis. So we prepare bank reconciliation statements on a monthly basis. This is when we reconcile the two balances. And then if you check there, the ones I was talking about, these differences that cause the two balances to differ. The first one here, we have got bank charges. On the bank charges there, how do bank charges cause difference between the cash book balance and the bank statement balance? So in the cash book there, you find that the bank is going to charge maintenance fees for maintaining or keeping your money and your records on your behalf. So those maintenance fees that the bank is going to charge, they will deduct from the bank statement. And then for you in the cash book, you won't have that entry. You only command no, or you can command prove that they deducted, even though you know when you receive the bank statement. Because in accounts, you don't just record things from without, we use source documents. We need to know the proof of a transaction taking place. So you find that the cash book balance is going to differ from the bank statement balance. You can only know that this is how much the bank has deducted after checking the bank statement or receiving the bank statement. So hence causing the difference between the cash book balance and the bank statement balance. And then you have errors and omissions. So you find that as a business, you might make mistakes. You might make an error, maybe in terms of amounts. You transpose figures, or you overcast or undercast an amount, or you record the wrong double entry. Where you're supposed to debit, you credit. Where you're supposed to credit, you debit. So that can cause a difference with what the bank has recorded on the other side. And then you find that that topic that you did, errors and omissions, it will come here. So those same errors, you'll be correcting some of them here. And then you also have standing order. A standing order is just simply an instruction written to the bank to pay specified amount of money on a specific date. So it's you as a business, you instruct your bank to pay a specific amount on a specified date. For example, maybe you tell your bank saying you'll be paying insurance premium every month on the 27th. So the bank is going to honor that instruction. Every month they're going to be deducting But you only come and record or see that they've actually deducted when you receive the bank statement, when you see your bank statement. So hence causing the difference between the cash book balance and the bank statement balance. So you find that the bank is going to deduct, and then on your end you won't have that entry until you check the bank statement. So hence causing the difference. Then you have things like unpresented checks and uncredited checks. So unpresented checks, they are also known as unpresented lodgements or uncredited lodgements. So for unpresented checks, these are payments that we make to our suppliers as a business, but haven't yet been presented for payments to the bank. So you find that you've paid your supplier, you've written them a check, and then you give them, but the supplier hasn't got in that particular month. For example, we are in August. I give you a check for August, and then you go and cash it in next month in September. So in this particular case, what will happen here is that you have that record, the bank won't have that record. They only have it in September. So hence it will cause the difference between the cash book balance and the bank statement balance. And then we have uncredited checks. These are receipts that we are supposed to receive from our customers or receive from our customers. So you find that someone has paid you, and then the money hasn't yet reflected in your bank. So you find that in most cases there should be a system error or certain things that has happened. Maybe they don't have insufficient funds in their account, so on and so forth. So that can cause the difference between the cash book balance and the bank statement balance. And then you also have direct debits, direct credits, and credit transfer, debit transfer. So they are just direct transactions where it's a transaction between your bank and the customer's bank or the supplier's bank. So you find that on the direct debit, it's where it's you paying. Direct debit, it's you paying from your bank to your supplier's bank. And then for direct credit, it's from your customer's bank to your bank. So you find that when those two are trading, you won't have that record that the money was actually received. So you only come and record that when you see the bank statement or proof of payment. So hence causing the difference between the cash book balance and bank statement balance. And then one important thing that I want you to note is that under bank reconciliation, in terms of entries, we view our cash book as an asset, and then on the bank side, we view that as a liability, or rather, they view us as a liability on the bank side. So you find that all transactions on the debit side of the cash book, of our cash book, appear on the credit side of the bank statement. So when you receive money, you debit the receiver. So you debit your cash book, but in the bank statement, they will credit your account. And then all receipts are found on the debit side of the cash book. And then in the bank statement, receipts are found on the credit side of the bank statement. Then for payments, all payments are found on the credit side of the cash book, but in the bank statement, it's the opposite. They're found on the debit side. Once you make payments, you find it on the opposite side, which is a debit in the bank statement. Then you create your account, credit the giver. So that's what I wanted you guys to note, that all transactions on the credit side of the cash book are found on the debit side of the bank statement. Then on the cash book on the debit side, all transactions on the debit are found on the credit side of the bank statement. And then we also look at the format. The format, we have two formats for a bank reconciliation statement. So we've got method 1 and method 2. So method 1 goes as follows. So you always have to write the title. Title is very important. You write the name there. So I gave an example there saying John Katita's bank reconciliation statement as at. So for bank recon is as at the month end. So 31st December 2024. So it could be any month. And then you start. When you're using method 1, you start with balance as per bank statement. That will be your first transaction there, or your entry. And then you come here, say add and create the checks. Add and create the checks. Let's give examples. If you've got 2 or more there, you put them under that column and then you take the total to the end. But if you just have one, just take it direct to the end there, to the end. So here I give an example, Uncle J, the accountant. Then total, you put it there, you add it to the balance as per bank statement, you add the 2, there you add these 2. Then you get this value there. Then you less and present the checks. The ones I was explaining to you. So you have, in this case, I give an example, JK General Dealers and Kolima HPOC. Then total, again, I put it there, I subtract because you're saying less. And then you subtract from that. You should be able to get your balance as per updated cash book to prove that what you've done is correct. If you want to prove that what you've done is correct, that's how you confirm. You should be able to get the balance as per updated cash book. And then if you're given such kind of a question where you've got tables, your uncredited checks are always found on the debit side of the cash book. Your unpresented checks are always found on the credit side of the cash book. So reason why I've explained these two, where I explain those terminologies and also the table, is because questions come differently. You find that sometimes they'll give you just tables, and sometimes they'll give you words you need to interpret. So this video is going to help you to be able to answer all those on how you get which ones you're uncredited, which ones you're unpresented. So that's how you get there, and you come and put. But you just need to check transactions which are in the so if you're reconciling the cash book and your bank statement, which is in the bank reconciliation statement, there are two things. They'll only ask you to update the cash book and to reconcile the two. So in the bank reconciliation, your focus when you're trying to reconcile the two is you look at transactions recorded in the cash book but not on the bank statement. That will be your focus when you're trying to reconcile the cash book and the bank statement. You look at, all those transactions which are recorded in the cash book but not in the bank statement. So you'll be ticking off. I'm going to do a follow-up video with regards to this one here, where you can be able to see what I'm talking about. And then when you're updating the cash book, your focus is transactions recorded into the bank statement but not in the cash book, and then you update. So that's how you go about it. And then the other method that I was talking about, method 2, is just now the opposite, where you still write the title the same way there, and then you start with a balance as per updated cash book. Then here when add, you say add unpresented, you change, you put unpresented there, you put the unpresented checks, you add back. Then you less and create the checks, you put the uncreated checks, then you less from there. You should be able to get your balance as per bank statement if everything is correct. So this was just an introductory video to help you guys understand what bank reconciliation statement is and how to solve the question. So look out for my next video where I'm going to be solving a question under bank reconciliation statement. So I'll solve a number of questions to help you guys understand and just to get the concept.